YouTube, what's good with y'all boys, man? As y'all can see by the title, today's video is going to be probably one of my favorite videos, but I'm going to pretty much be going over what I would do if I had to start from scratch, if I didn't know anything, what I would do to become a profitable trader in 2026, you feel me? Because as y'all know, the new year is practically upon us. Less than 24 hours away, we will be in a completely new year. There's no need for no New Year's resolutions, man. You should already be working. You should have already been putting in work. That way, 2026 start, you just keep the ball rolling. You feel me? So, if not, hey, man, you still got a little time. You got less than 24 hours to start now. You feel me? Don't wait, because then you'll never start. Keep telling yourself, I'm going to do it then. I'm going to do it tomorrow. I'm going to do it the next day. Then all those days come and pass, and what have you done? Nothing. So, but I'm gonna quit yapping and I'm gonna jump straight into the video, man. But yeah, if I had to start trading from scratch, didn't know anything, first and foremost, what I would do is get on YouTube like you're already doing now. Watch some videos, figure out the basics, you feel me? And I'm gonna go over market structure, liquidity, you feel me? Confluences, fair value gaps, you know what I'm saying? And then at the end, I'm gonna show you how to put it all into a strategy. And also, you need to know what a funded account is, a live account, which I have videos on that in my Telegram, but for the sake of this video, we'll go over all of that again in one video. You feel me? Everything you need to know to become a profitable trader in 2026. So without further ado, I think I'm gonna just throw y'all to the charts. You feel me? Okay, I just thought about something. Before we get to the charts, I'm going to talk about funded accounts versus live accounts because you don't really need the charts for that. But funded account, how I like to explain it, is basically a loan for traders. But in order to get said loan, you have to prove to the loaner that you know what you're doing with said money. Right? My bad, the camera angle looked off. So once you prove to them by passing your combine or your evaluation phase, is what you see on TikTok, everybody on funded accounts, prop firms, once you pass your challenges, then you get to make real money from said loan. But until you pass challenges, it's pretty much a glorified demo account, right? Live account is, as in its name, it's a real live account. It's your funds, your money, which I don't recommend beginners starting out with a live account because 9 times out of 10, you don't have a lot of money to start with. And even if you do, you don't know what you're doing. So you're just going to lose the money. So you may as well just buy funded accounts below those and just buy more. You feel me? It's much less of a risk than actually trading with your own capital. Because you'll lose it faster. Then you're going to call it a scam. Trading doesn't work. This, and that. So to save yourself from that, start off with a funded account. Feel me? And like I said, once you pass the challenges, you get to make real money from it. You take the payouts from the funded accounts and you use those to fund your live account. You feel me? Don't ever just jump off the bat with a live account unless you're trying to trade with like $1,000 or some shit like that. Like, that's cool to lose. You feel me? That's not going to mess with your psychology too much because you should know that you're never going to have a 100% win rate in trading. It's literally no one has a 100% win rate. No one that I know, at least. So get that out your head and start with a funded account. You feel me? Everybody do it. You stack funded accounts, you can make a decent amount of profit. Then you build your live account. Cool. Now you know the difference between a live account and a funded account. You know when you should make the switch. You should make the switch when you get payouts from the funded accounts. And now you have a big enough live account to actually make some significant money with. And that's the easiest way I can explain those two topics. Feel me? Okay, cool. So, you want to know about day trading? First and foremost, you need the platform to be able to look at these charts. And that platform would be TradingView. You can download it on your phone, you feel me, laptop, web browser, all of that good jazz. Just get to TradingView and get to the charts. Cool, cool. So once you load it up, made your account, your screen will not look like mine. It will most likely be white. And your candlesticks will be red and green, and mine's only different because I changed it. It just helps my eyes, and I like the colors. You feel me? But you need to know what you're even looking at because you're most likely thinking, what is all these squiggly ass lines? Cool. That's beautiful. We call those candlesticks. And they're candlesticks because you know how when you burn a candlestick, the little black wick, it burns down to the body of the wax of the candle. It's the exact same thing that's being represented with these, right? This one in particular, this big white candlestick to the downside, we have the wick, right? It's burning down, and that's where the body starts. Same thing for the other side. Came down, that's where the body closes. And how I know that's where the body opens and closes is because candlesticks open in one direction, right? So if it's an up candle, because it will be green for you. Let's say we have a down candle. I'll change the color for the representation. Boom. Right? Up candles, green candles, they open at the bottom, close at the top. Down candles, the red candles, they open at the top, close at the bottom. And that gives you, can I move it, is 1. There we go. Those two candles side by side give you structure points. Just like here, we come up, green candle comes up, that'll be a red candle for you, it goes down, right? That's an elbow point, that's a structure point, that's a high point, which we'll get into that in a second. But for now, let's just talk about the candlesticks. Now let's go on to the wicks. Boom. This will be the wick. Make it straight. Hopefully that's straight. If not, oh well. Right? We could even have a wick like this. Right? No matter where the wick goes, how far up or how far down it goes, it doesn't matter. The candlestick closes at the body. That's the main thing that we focus on. Where it opens up here and where it closes down here. Or opens down here, close, move down. We open here, close down here. The next candle, if it was a up candle or a green candle, bullish candle, it would open down here and close up or wherever. If it was another down candle, bearish candle, red candle, it would open down here and close somewhere down here. Right? That's candlesticks. And then the wicks just tell you where price has been, and it tells you the areas that it's rejecting from. Cool? Cool. Now you know what the candlesticks are. You know what the wicks are. Right? And I need to learn how to read them, which is called market structure. Right? So let's get into market structure. Let's look at the charts first. I'm gonna pass this out. Let's just start from up here. Boom, 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 boom. Each turnaround point is a structure point. I'm not gonna add all of these because it's an uptrend, so we'll just go to here, come down, come up. But all of these count on the inside, but not really at the same time, which it'll make sense in a second. I'm just passing it out. Boom, 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 boom. We'll go over here, 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 come down, back up, down, here, and we'll just, for the sake of it, come down here, back down, and now we are here. Alright, so let me pull that out the way. And let's just, God, that looks horrible. But this, if you could tell me what trend we're in right now, which is pretty obvious, this is a downtrend, and you're one step closer to reading market structure. Right? Now let's just go over how to read this. Let's just say we started here. This is our last high point, right? This will make this a low point. This will make this a lower high, a lower low, a lower high, lower low, lower high, lower low, lower high, lower low, higher high, higher low, right? I'm gonna get to why it switched in a second. But then we have a high. It's not anything else yet, just a normal high. We broke below this low, lower low. That makes this our last lower high. We come up, boom. None of this matters. This doesn't matter until we broke below this the last lower low. So what would that make this? A lower high, right? Come up. We did take it out, just barely. We'll count it. Lower high. Well, this will be a higher high, higher low. Technically, this would be a higher high, but what did we do? We broke below the last lower low, so this will make this another lower low. Make that our last lower high. So forth, so forth. Nothing happens, nothing happens. This will be our last lower high because we broke below the low, lower low, lower high, lower low, lower high, lower low, higher high because we broke above a high. But it doesn't matter because we came right back down. So this is still technically a downtrend because we still have not come back up above this or below these lows, right? Now, the reason why it switches is because, let's see, where was it? Boom, 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 boom. Never mind. Let me take that point back. It's still a downtrend. But how do you know when a downtrend is shifted? Let me draw that out for you. So let's say you shift the structure to the upside, right? Consistent lower highs and lower lows. That is what makes a downtrend. Until we break above these highs, that makes it shift in the structure. And we don't go back below those lows. If we come all the way down past those lows, we're just continuing the trend. You can't shift the structure to a downside again. You feel me? We're just continuing the downtrend. And this would just be a liquidity sweep, which I'll get into later. But for the sake of this, it's nothing. You feel me? We're just continuing the trend. But if we did this and then made higher highs and higher lows, that is a shift of structure. Shift of structure happens right here. And this will just be a pullback to create the next higher low. Right? This is a lower low, lower low. But this shift of structure, which makes this a higher high, we're looking for a higher low, which would be here. Boom, higher low, higher high, higher low, higher high, and this is nothing until we either A, break back above this high, or break below this low. Like if we did this right here, we should have structured back to the downside. But if we didn't, and we just went up from there again, still continuing the uptrend. See what I'm saying? Cool. Now you know what market structure is. You know what trends are. An uptrend, I don't know if I drew that out. It's just the same thing, but in a complete opposite, right? Higher highs, higher lows. That's an uptrend. Oh, my bad. And that's a downtrend. Higher highs, higher lows. Lower highs and lower lows. You don't shift the structure until you sweep above a high and keep going. You don't shift structure unless you keep sweep below a low and keep going. Make sense? Cool. So you know how candlesticks open, you know how candlesticks close, you know what a candlestick is, you know what a trend is, uptrend, downtrend, you know how to identify them, you know what highs and lows are. Now let's just jump straight into liquidity. Because I like to view liquidity as gas for your car. You feel me? Without gas in your car not moving. Without liquidity in the market isn't moving. Right? So in order to create these highs and lows, we got to have momentum into the market. Because if we didn't have momentum or liquidity or volume in the market, we would just do this right here. Up and down, up and down. Like, that's ugly. Who wants to trade that? We need moves. not just chopping, not consolidation. That's what we call consolidation, right? So liquidity is used in the market, manipulation, whatever you want to call it, right? So let's just identify what liquidity is. Liquidity is resting money below or above highs and lows, right? So let me draw it out before I go to the charts again. So let's say if we have a high, a higher low, higher high, and a higher low. But at this point right here, we have one or two options. If I was trading just those two highs and those two lows, I'm either going to look for this high to get swept, which would most people would think that we're going to continue the uptrend and they're going to be entering buys right above here, right? Most people are going to be looking for buys right above there. And what the market maker will do, they'll know that, take out those highs and continue down or shift the structure, right? Because you just allow them to fill in, you know what I'm saying, their buy orders. It's that simple. That's a liquidity sweep, right? So to the downside, my bad. So, okay, again, we're here. At this given point, I'm either waiting for this low to get swept to move up and shift the structure, or we could come up and take out these highs and then shift structure back to the downside, right? But in this case, for the opposite, let's say if we come down, boom, we swept out this low. Now what are we waiting for? Boom, reaction out of it. Back to the upside. That is a liquidity sweep right there. Sweeping a set of lows and have a rejection point from it. Sweeping a set of highs and having a rejection point from it. And then you're targeting unchecked highs or unchecked lows. If you're buying, you're targeting unchecked highs, which would be these, right? If you're selling, you're targeting unchecked lows, which would be those. Let me delete these out of the way. Right? And this one. Feel me? Wait for this high to get swept. It got swept. You're looking for confirmation. Boom, you get your confirmation. Your targets is either this low or this low. You feel me? Low resistance draws on liquidity means that those lows just make more sense to get hit. Low resistance liquidity for buyers would be these highs just make more sense to get hit. You feel me? That's how you identify liquidity. That is what liquidity is in simple language. So let's just go back to the chart so I can show you some actual examples of what they look like in the live markets. Remember, liquidity is resting money sitting above highs and lows. You wait for those highs to get swept. Make sure we're getting the reaction confluence out of them. And then you enter, targeting unchecked lows or unchecked highs, whichever way whichever way your bias is going. Right? Liquidity sweep right here, pretty much. I actually tried to enter off of it, but I entered in too early. Feel me? That's where you gotta be patient as well, and you also gotta make sure there's no news, or if there is news, you feel me? That type of stuff. Sorry, plays a big role in a lot of it. So boom, these lows got swept twice. Then we finally get our overall move up, right? See if I can find right here. Here's a high point. It got swept. That's a beautiful reaction. Candle wick comes right above it. Closure below the high. Doesn't matter really, but it's best to have the candlesticks not close above it. So if you just see wicks above it, that's beautiful. That's what you want to see. An immediate move down. Right? It doesn't matter the size of the sweep either. These are 15-minute lows. Get swept out. Boom, we moved up. Right? All of those draws on liquidity. Let's keep going. Should get you some more examples. Just in case you still not picking up what I'm putting down. Right? Right here. High point. Move down and a move up. Sweep work. Move down. Target these lows. Feel me? Makes sense. Right here. Sweep work. Move down. Liquidity is everywhere, man. Targeting unchecked highs and unchecked lows is one of the easiest ways to read the market. Right? Let me delete all of this. This from the previous video, my bad. Right? Even right here, I caught this trade. Okay, down, swept these lows, move up. I could have held this position for a lot longer, but I didn't because I was already up 15 points. That's cool in my book. Liquidity sweep. And we even came back and re-swept the same lows right here. You could have targeted right there. Feel me? Some more to the downside. Sweep work. Move down. Feel what I'm saying? You're understanding, you're picking up what I'm putting down. Doesn't matter the size. Right here. Boom. Same motion. Came down, swept them, move up. So that's why I use liquidity into my strategy. Because if I get a liquidity sweep in my session, oh yeah, baby. That's a golden ticket. You feel me? Don't mind that over there either. We'll get to that in a second. Okay, boom. We just talked about liquidity. Now you know how liquidity works. You know what candlesticks are. You know how they open, how they close. You know how to read market structure. You know how to build a trend. Consistent trend for an uptrend or bullish trend. Higher highs, higher lows. Downtrend, bearish, lower lows, lower highs. Right? You got market structure. You got candlestick patterns. You got, what do we call it? Liquidity. Now I'm going to teach you about confluences like fair value gaps and SMTs. Because those are the only really confluences that I use. So we'll just jump straight into it. Right? What is a fair value gap? A fair value gap is a 3 candlestick pattern. I'll draw it out. Don't mind the colors. Because this is a bullish fair value gap. So usually, in your case, would be green. Right? Now, it doesn't matter if the candlesticks have wicks or not. So, let's say if one candlestick has a wick, but the other one doesn't. It doesn't matter. Right? The gap comes from, if there is a wick to the body of the third candlestick. It's a gap between the first and the third candlestick. Let me change the color. Right? There's a gap. I'm trying to touch the screen like you can see what I'm doing. There's a gap in between this candlestick, which is the third, and this candlestick, which is the first. Even if I took this wick out, it would just go from wick to wick. Right? Or let's say if this candlestick had a wick and it was way down here. You just move the gap. And let's say if this candlestick had a wick and it was right here. You just move the gap. There's still a gap. Doesn't matter how big it is. You feel me? A gap is a gap. That is a fair value gap, or otherwise known as imbalances. And when you get imbalances in the market is most likely going to want to balance it back out. So what will it do? It'll come down, fill it, and keep going back up, continuing the trend. Right? Let's say if the candlestick, let me change the color again. Right? Let's say if the wick comes way down here, it doesn't matter. Why? Because I told y'all, we're looking at the candle closure. Where does it close at? Remember I told you down candles close at the bottom. So if it opened up here, we have candlesticks coming down, down, down. And we get right here, price comes all the way down, but it comes all the way back up. And as long as it closes within that gap, the fair value gap is still valid, right? If it doesn't, and we get a candlestick closure down here, well, now that fair value gap is inversed, which we'll get into inverse fair value gaps in a second. But it's the complete opposite if we're go looking to the downside. Still a 3 candlestick pattern. Doesn't matter. Right? The gap is in between the first candlestick and the third candlestick. Right? Even if there's wicks, it could even be just a tiny wick. And this one could be, oh, I didn't click on it, a big wick. Again, as long as there is a gap, it's still a gap, right? Size does not matter, my friends, not in trading. Imbalances are imbalances. And how this would be inversed, if let's say if we get the candlestick, damn, I'm tripping. Just like that. As long as we don't close, or this would be a green one for the sake of the video. Just remember, this will be a green candlestick because we're inversing it. That means we're turning around, right? Even if the wick comes all the way up there, as long as the body closes within the gap, we're still cool. You feel me? Now again, if this candlestick closed up here, that fair value gap is now inverse. Remember, same thing over here. As long as the candlestick closes within that bullish fair value gap, we still have the potential to keep going up. But again, if it closes down here, we're most likely going to continue down. We're shifting the structure. Right? Picking up what I'm putting down. Same thing over here. As long as we close within the box, we good. If we break out above it, that fair value gap is inversed. Make sense? Cool. So let's go to the charts because fair value gaps are practically everywhere. Fair value gaps is one of the most, you feel me, imbalances, because most people don't like the word fair value gaps for some reason. But imbalances is just as useful as liquidity. Because once you get the liquidity sweeps, you're most likely going to have imbalances that come off of it. Like, those are not good representations. Oh my Lord. Those wicks were insanity. This trade that I caught. Mind you, I'm on a 15-minute time frame. I actually think I drew the box in there. I'm going to go down to the 5-minute time frame so I can actually show you. Bro, we'll just use this. This is a small one, but we'll use it as an example. Remember I told y'all size doesn't matter, right? So we got a high point right here. We came up and we swept it. And what do we get off of that sweep? An imbalance, this red box. I have fair value gap indicator so I don't have to draw them out myself. Right? Liquidity sweep, we came up, swept these highs. What do? We had a reaction from it. We're rejecting that high. Come off that high rejection with a imbalance. I would have entered. If I scaled down to the 1-minute time frame, I probably could have found a quicker fair value gap in there to enter off of. To target all of these draws on liquidity. All of these are low points, resting money, and it's also a trend line. That's easy money. You feel me? A trend line is basically an uptrend that you can just draw a line through. Literally. That's a trend line. It's just an uptrend. It would be vice versa if it was a downtrend. It's just a whole bunch of stacked lows. Stacked lower highs. Right? So I told you about the liquidity. You see how liquidity works with fair value gaps. Now I'm going to go over SMTs. And for the sake of, for the sake of this video, that's insanity up there. We're not gonna go back up there. For the sake of the video, what did I say? We were talking about SMTs, right? I'm just gonna draw it out because I could switch back and forth between GBP USD and Euro USD because those are twin sister pairs. They move pretty similar. So if one pair is significantly moving up to a set of highs and the other pair is not, that's kind of like a confirmation that one of those pairs is lagging. But it also has to shift the structure once we reach said level on one set or one pair and not the other, which I'm about to draw it out here, right? In simple language, an SMT is when one correlating pair sweeps a set of highs, like this. Okay, never mind, fuck it, yes. We'll leave it like this for now, right? And let's say, I drew that too high, right? And we're doing the same thing on the other pair. But instead of coming back up to this high, we stop. Right? Now, the key factor when you're looking at this is what do the pairs do once we come above the said high? If this reverses from this point and goes down, along with the other pair, it goes down, that's what we call an SMT. When one pair breaks a set of highs and the other pair does not. That's where you get the SMT from. This would be a bearish SMT because we're going down from this point. Feel me? That makes sense? Let's draw it out for one to the downside. Lower high, lower low, lower high. We sweep this lower low on Euro USD. GBP USD is doing the same thing. Lower high, lower low, lower high. But we don't sweep the lower low. Where is the SMT? When this pair went below this low and this pair did not. This would be a bullish SMT because once we see this, it's most likely going to go back up. And in my case, I would take the trade on Euro USD if this was Euro USD and this was GBP USD, because Euro USD came down and swept these lows, which is my liquidity sweep, thus giving me the SMT because GBP did not come down. Now I'm looking for imbalances, which I would probably get off of this leg up, and the inverse of an imbalance is probably from this leg down. That's all I need to enter a trade, and I'm targeting these unshaked highs or any high in between there. Same thing for GBP USD, which I probably wouldn't trade it, but in this scenario, if you did, you target the same thing. You just wouldn't have a liquidity sweep unless there's some internal lows in here. You feel me? But that's the SMT, right? This is a bullish SMT. I mean, this is a bearish SMT because we came up and swept a high and moved down on whatever pair. But this pair did not sweep the high, but they both moved down. That's the key factor. They have to shift the structure from that point, right? Cool. Now you know about how candlesticks work. You know how to read them. You know what a trend is. You know how to read market structure. You know what highs and lows are. You know what liquidity is. You know how to find fair value gaps. You know what an SMT is. Now I'm going to show you how to put it all together and build a strategy out of it. Boom. Now, to wrap everything into one big shebang, you feel me? This is how you can use all of everything that I just taught you to build a strategy with, right? All right, cool. Let's just start. We'll use this right here as an example, and then I'll use my actual trade in a second. But, all right, so here's a low point that got swept. Boom, you got your SMT, right? Now, for the sake of this video, because this shit's already long, we're not going to go to GBP USD because it's going to take me fucking forever to find this point. If you use TradingView, you know. If you switch pairs, for some reason, for me at least, it never switches me to where I need to be. And then I always forget where I am, and I just don't got time to find it. So you got to take my word for it that GBP comes down and does not sweep out this low, right? It happens, which I'll show you an actual trade that I took that has an SMT in it so you can see for yourself. But for the sake of this right here, because it's a liquidity sweep, and it's a beautiful liquidity sweep, you could use, boom, we sweep it. And we have all of these imbalances right here. We have two, which would just be a stacked imbalance in my opinion. This whole range is an imbalance, right? That whole red box. Right? So after coming off this liquidity sweep, I would be like, okay, we have these two imbalances right here. I'm looking for these to be inversed, and then I'm also looking for another fair value gap going in the opposite direction. And if you can see, it is quite small because I'm on the 15-minute time frame. This little small box right here. This is a fair value gap. No matter how big it is, it doesn't matter. Feel me? That red, damn, let me turn. That red box is a fair value gap. All right, you can see the green one. They're connected, right? As you can see, it's still respected. We had these candle wicks come all the way down, but they still closed above the box. That's all that matters. That would have gave me my trade setup, my entry, and I would have targeted either these highs, probably TP1 would be here, right? And TP2 would be here. I probably let that bitch run. Feel me? Makes sense. Liquidity sweep, imbalances. Sometimes SMTs happen, sometimes they don't. Now let me show you a trade with the actual SMT. This one right here. On GBP USD, it came up and took out these highs, but it definitely didn't take it out on Euro USD. And at the same time, we was tapping into a old fair value gap and inversing a fair value gap with another fair value gap. So I was like, boom, bro, that's clear as day. That's enough confirmation for me. For my stop loss above that fair value gap and above, this would be London session open for me. So above London session open highs, for my stop loss above it and above that fair value gap. And then I just let the magic happen. Targeted these lows. And as you can see, we banged out. Even right here, there was no SMT. I just entered off of this liquidity sweep. Feel me? We had massive legs down. And I scaled down to the 1 minute time frame. And I found an entry in there. Targeted those lows. I could have held it longer, but I didn't. Right? This is liquidity sweep right here. Move down. The strategy is pretty simple. If you don't get it, you don't trade. But I at least need 3 out of my 4 or 5 confluences, or at least 3 to 4 to 5 of my steps for my setup in order for me to take a trade. And I at least need a liquidity sweep or an SMT. If I see SMTs, okay, I would take that, just like I did right there. As you can see, it worked. And if I see liquidity sweeps, I would take that without an SMT. As you can see, it worked. And even here, this is a whole consolidation on a 5-minute time frame and the 15-minute time frame. But those are low points still that we swept. Liquidity sweep. And I took the trade. And I closed it because, hell, this was 2 hours. This was 2 hours of price action. I was like, I'm done. Taking my money and I'm getting out. You feel me? It is, and that's another, this right here is a whole another setup that you can use. It's called accumulation, manipulation, and distribution. Accumulation is the same as consolidation. It's the same as chopping price action. Whatever you want to call it, right? We're most likely going to manipulate to the upside or to the downside. And then you'll have your distribution to whichever correlating opposite side that it went. So in this case, we had accumulation. We manipulated down to these lows. Then we moved up. Beautiful. Liquidity sweep and fair value gaps. We inverse the fair value gap with the fair value gap. Also the accumulation, manipulation, distribution pattern. Also we had a liquidity sweep. That was the most clear trade I've ever took in my life. You feel me? It don't get no simpler than that. Liquidity sweeps. Move up. Feel me? That's just how the market moves. And the quicker you can realize that, the quicker you can make you some money. I already drew this out. Liquidity sweep, move up. Once you get your liquidity sweep, you're targeting the other side's higher lows. I mean highs or lows. And that's pretty much it. You know what candlesticks are. You know how they open. You know how they close. You know how to identify the market structure, highs and lows. You know how to spot an uptrend, consistent highs and consistent higher lows. Downtrend, lower highs and lower lows. You feel me? You know what liquidity is. Resting money above highs and lows. You wait for it to get swept and have a rejection from it, and you target the other side's highs or lows, whichever way it's going, whichever way you get the sweep from, right? You know what an SMT is. When one pair of two correlated pairs breaks a set of highs or lows and the other pair doesn't. But they both shift the structure to whichever way that it was going opposite. Right? You know what fair value gaps are. It's 3 candlestick pattern. It's a gap in between the first candlestick and the third candlestick. Right? And I just showed you how to put it all together. And that is how I would learn how to day trade. If I had to start over, I would learn all of those confluences and learn how to put them together, because they're the easiest and they just make the most sense to me, at least. So I can only tell you what helped me. You feel me? And that was the easy thing for me to grab. Once I learned about liquidity, fair value gaps, and SMTs, everything took off for me. Everything else just seemed overly complicated. Like everybody be having PD arrays, block this, block that. I'm rejection. Nah, bro. I don't use all those terms, bro. I don't know. You don't need all that. Keep it simple, bro. Like I tell y'all, the market is already rigged against you. Don't rig it against yourself even more than it already is. You feel me? Keep your strategy short and sweet and be consistent. That's the main thing. And that's all I got for y'all. I'm done yapping. I'm done with the charts. Boom. So now you pretty much know how to day trade. The only thing you need to do now is get into the markets and start to use these confluences. Use all of these, you know what I'm saying? Use everything that I just taught you for yourself and see how they really work within the live markets, man. And that is the 20% skill. I just taught you how to trade in, 30 minutes, right? Now, that's not the easy part. That's not going to make you profitable. You feel me? Well, who's going to make you profitable is the way you think about trading, how you view trading. Because if you're getting into trading thinking I'm finna make a whole bunch of money and that's your only goal is to make money, good luck. You feel me? You're going to lose faster than you're going to win. I can tell you that much from experience. You got to detach yourself from the money. The money is a byproduct. If you learn how to read these charts on a daily basis, day in and day out, you're consistent, you're showing up, you're following your plan, you'll get rewarded with the money that way. And that way you have pretty much an infinite money glitch. You can't go broke if you know how to read these charts. Feel me? If you being disciplined and following your strategy You probably won't be taking dumb trades that don't make sense to you. So even if you do lose a trade that makes sense to you, it's much better than losing a trade and you don't even know why you took the trade. You feel me? That's where the psychology comes in. And the quicker you can realize that, and the quicker you can get over the fear of losing and detach yourself from the money, the faster you could, you know what I'm saying, speed up your trading journey. Because I know no one wants to sit here and lose money for years on end. And then there's no chance that, there's no guarantee that you actually even make money from this. You feel me? So I'm just trying to help you speed up your process, man, without you having to take too many L's like the rest of us. So hopefully you found this useful. You feel me? You pretty much know how to trade. Now you just got to master yourself. I can't teach you how to master yourself. All I can do is tell you how to trade. Really, bro. It's the easiest part. You learn the rest by market experience. That's the only difference between you, me, and the niggas that's above me. Just market experience, bro. Gotta learn how to adapt to the markets and never marry your bias. And with that being said, my friends, this is gonna end the video. Hopefully y'all are working. Fucking New Year's resolution, man. Start now. That's all I got for y'all, man. Hopefully y'all enjoyed the video, man. Y'all stay blessed, stay motivated. And I'm gonna catch y'all in 2026.